We have covered chapter 1, 2, 3, 4. Chapter 1, 2, 3, 4. Let's cover some questions from BPP Kit for chapter 2, 3, and 4. In your BPP Kit, question number 25. Foster company has built a new factory incurring the following cost. What you need to do? What will be the total amount capitalized in respect of the factory? Mean what amount should be capitalized, mean recorded as asset relating to factory. Land should be capitalized. Material should be capitalized. Labor should be capitalized. Architecture's fees, yes. Surveys fees, yes. Site overheads. Site overheads. Administrative no. So land should be capitalized, material should be capitalized, labor should be capitalized, architecture fee should be capitalized, survey fees should be capitalized, site overhead. Site overhead mean relating to that factory site should be capitalized. Portion admin overheads. Admin overheads should not be capitalized. Testing of fire alarms. Yes, it's a compulsory part of the building. And business rate for first year. Business rate, not relating to factory. These should not be capitalized. Business rate is tax. You can say it's relating to business, not relating to that factory specifically. So out of this is 7112, 162 should not be capitalized. So what's the answer? 162. 7, this 150 plus 12, 162. So these should not be capitalized. If you deduct these from 7112, what's the answer? Yeah, 1953. What's the answer? Sorry, 6950. 6950. So option B. Okay, 26. What we need to do, calculate the borrowing cost, which can be capitalized in respect of this project for the year ended 31st December 20x8. Mean what cost should be capitalized into the asset? Carriageways company had the following bank loans outstanding during the whole of 20x8, which form the company's general borrowing for the year. 9% loan repayable in 20x9, the amount is 15 million, and 11% loan repayable 20x2, the amount is 24 million. These are general borrowing, not specific to the asset. If we are using money from these loans into the asset, then we will consider them. Otherwise, we will ignore them. Carriageways company began construction on a qualifying asset on 1st April 20x8. They started construction on 1st April. So from start of construction till end of construction, the cost should be capitalized. And withdrew fund of 6 million. Withdrew fund of 6 million on that day to fund the construction. From where? From these loans. They used 6 million into the asset. But we need to capitalize borrowing cost. Borrowing cost means interest. From where they took the 6 million, from this 9% loan or 11% loan? We don't know. If they were specifically saying we took this amount from 9% loan, then we will use 9% interest rate. Or they took this amount from 11% loan, we will use 11% interest rate. But if there are so many general borrowings, So we need to calculate the interest rate using the weighted average method. What's the weighted average method? 9%. What's the amount? 15 is equal to what? 135. And 11%. What's the amount? 24 is equal to what? 264. 264. And all together they are 39. 39. So what we will do 399 divided by total of these two. What is total of these two? 39. So can you calculate the interest rate? 10 point 10.23%. So they took 6 million from this when on 1st April. On 1st August 20x8, an additional 2 million was withdrawn from the same purpose. So on 6 million, we will apply 10.23%, but we need to see whether how many months. And on 2 million, we will apply the interest rate for the complete year 10.23%. So calculate the borrowing cost, which can be capitalized in respect of this project for the year ended 31st December 2008. When construction was completed, they haven't provided any information. So we will assume the construction is continue onward. This means on 1st April, we use this for how many months? 9 months. Yeah. And on 1st August, we use 2 million. For how many months? August, September, October, November, December, 5 months. Can you calculate both these amounts? Six million into 10.23% into 9/12. What's the amount? 460. 460. 385. 385. Okay, what about 2 million into 10.23% into 5/12? This amount? 9 something? 85. Sorry, 8525. 25? 8525. 8525? 8525. Please add both these. 53654545635. 54663. What's the option? Option 1, 2, 3, 4. Not matching any of the option. They have calculated the figures based on interest rate rounding. They have rounded to 10.3%. Oh. If you calculate based on 10.3%, you will be having exact this figure. Even if we have calculated the answer 545, it is not near to 533. It is not near to 824. It is not near to 480. It is near to 549. There is a difference of 4 to 5,000, because against this there is a difference of 12. But if you calculate based on 10.3% interest rate, you will calculate the same figure 549,333. Yeah, the upper 463,500. 463,500, and the next based on 10.3%. Yeah. But in exam paper, they will provide you accurate figure. It's a kit question, not exam question.
85833.
833. So you will get the exact figure 549333. Okay, let's move towards 27. 27. What we need to do? Calculate the borrowing cost to be capitalized for the year ended 31st December 20x9 in respect of this project. Leclerc company has borrowed $2.4 million to finance the building of a factory. Means specific loan for the factory mean asset. Construction is expected to take 2 years. Mean construction will complete after 2 years. The loan was drawn down on 1st January 20x9. Mean they took the loan on 1st January, but we need to see when the construction started. We need to capitalize the amount when construction started, because between construction start date and completion date, all cost, including borrowing cost, should be capitalized. Before construction started date, after construction completed date, cost should not be capitalized. They should be treated as expense. Okay. So the loan was drawn down on 1st January 20x9 and work began on 1st March. This means from 1st March onward, we need to capitalize. 1 million of the loan was not utilized until 1st July 20x9. Mean there was a requirement of 2.4 million initially. 1 million was extra. So Leclerc was able to invest it until needed. So they invested somewhere. And if they invested somewhere, that we need to deduct from the borrowing cost. So Leclerc company is paying 8% of the loan. Mean interest rate they are paying against borrowing is 8% and can invest a surplus fund at 6%, and they are receiving interest income at the rate of 6%. So 2.4 million is the amount. Interest rate is 8%. How many months we have utilized into the asset from 1st March onward till 31st December? This means 10 months. You calculate the amount, please. Come on, come on, come on. Use your hand quickly on the calculator. Quick calculation. Like you are sitting in a stock exchange market.
160,000.
160,000. Less the investment. They invested how much? 1 million. And they are generating 6%. For how many months they have invested? 1 million they have invested for 6% interest rate from how long? From 1st July onward. This means 6 months. 6 months. So into 6 by 12, what's the amount? 30,000. Complete 30,000. Yeah. What's the answer if we deduct this from this? 130. Please check again. 2.4 million was the amount. 8% was the interest rate. And they used from 1st March onward. 1st March mean they used for 10 months. Year end is 31st December. Is that 160,000? 2.4 million into 8%.
Yes.
2.4 into 0.08 into 10 by 12. That is a 60.
160.
160. 160,000. And they invested 1 million. into 0.06 for how many months? For 6 months, and that is 30,000. So the borrowing cost that should be capitalized is 130,000. That could be the correct option. 1, 2, 3, 4. It's not matching with any of the option. 1 million of the loan was not utilized until 1st July.
So does it mean from the beginning of the year till 1st July?
Yeah.
It's not.
Out of this, till 1st July, that was not utilized.
Must be 7 months.
So 1 million of the loan was not utilized until 1st July. Mean they invested till 1st July. This means from 1st March, April, May, June. For 4 months they have invested. Mean relating to this asset, how many months we received the interest income from March till 30th June. March, April, May, June. Mean they took the loan on 1st January.
Yeah.
They invested on 1st January. Suppose they invested on 1st January.
Yeah.
They received income for 6 months.
Yeah.
But relating to this asset, how many months? If we are charging interest from 1st March, so we will net of the income from 1st March till that period. So March, April, May, June. For 4 months, we need to charge income to this asset. Remaining first 2 months, we will record in profit and loss account. Mean this amount has been invested for 6 months. But here they are saying 1 million of the loan was not utilized until 1st July. So was able to invest it until needed. Mean till 1st July they invested. After 1st July, they back and used. So for 6 months, first 6 months they invested, they generated income for the 6 months. But relating to this asset, if we are charging interest from 1st March onward, so we will deduct income from 1st March onward, like with like. So March, April, May, June for 4 months. What is the amount for 4 months? 20,000. So it is 140,000. So option is technical. They generated interest income for 6 months. But to net of income to this asset is for 4 months, not for the 6 months. The first 2 months income will be recorded as other income in profit and loss account. Will not be adjusted in the asset cost. Is that fine?
Yes.
Okay. Question 28. Which of the following statement is correct regarding investment property in accordance with IAS 40 investment property? Investment property is excluded from depreciation if we are recording on fair value model. If we are revaluing the investment property, the gain or loss should be charged to profit and loss account. Gain should not be recorded as revaluation surplus. Relating to PPE, revaluation gain should be recorded as revaluation surplus. But relating to investment property, the gain should be recorded in profit and loss account. So which of the following statements are true regarding investment property IAS 40? Transfer of IAS 16 property to or from IAS 40 investment property should only be made when there is a change in their use. In either we gonna use the property for business, so we will move from investment property to property, plant and equipment. If the business use property, we are going to change the use as generating income. So we'll move property, plant and equipment to investment property. So this statement is true. Is that true? Number 2, Transfer from an IAS 40 investment property to an IAS 16 property must be made at a fair value of the investment property at the date of transfer. Mean when we are transferring property to property, plant and equipment, we need to transfer according to current fair value. This statement is also true. 43. An entity should treat any difference between the measurement of IAS 16 property, plant property and the measurement of IAS 40 investment property at the date of transfer as an expense to the profit and loss. No, there is no expense to the profit and loss. So this is not true. So what's the correct option? B. Question 29. Identify whether each of the following statement is true or false in accordance with IAS 40 investment property. Following initial recognition, an investment property can be measured at either cost or fair value. Mean after initial, they can be calculated using cost or fair value model. So this is true. If an investment property is held at fair value, this must be applied to all of the entities investment properties. Yes, all properties should be using the same model. An investment property is initially measured at cost. Yes. Yeah. Subsequent can be measured at cost or fair value, including transaction cost. Yes. A gain or loss arising from a change in the fair value of an investment property should be recognized in the revaluation surplus. No, revaluation gain, even loss should be recorded in profit and loss account rather than revaluation surplus. Revaluation gain relating to PPE should be charged to revaluation surplus. Loss to profit and loss account. But relating to investment property, either revaluation gain, either loss should be recorded in profit and loss account. Question number 30. What you need to do? What amount should be capitalized as borrowing cost at 31st December 20x8 in respect of this asset? Fidofeed company had the following loans in place throughout the year ending 31st December 20x8, which constitute its general borrowing for the period. 10% loan, 140 million, 8% bank loan, 200 million. On 1st July 20x8, 50 million was drawn down for the construction of a qualifying asset, which was completed during 20x9. So you need to calculate the interest rate using weighted average first. So 140 into 10 is equal to 1400. 200 into 8 is equal to 1600. Altogether, this is 340. This is 3000. So 3000 divided by 340 is equal to what? Interest rate? 8.823. 8.82. 8.82%. How much amount they have drawn? 50 million into 8.82% for how many months? From 1st July till 31st December. This means for 6 months. How much is the amount? 2 million and
205.
make it this complete 8.
Stop.
Last option 2.2 million according to 8.82%.
Yeah, it's
Yeah, that's fine. Simple. Question 31. What amount will be charged to profit or loss for the year ending 31st March 20x8 in respect of depreciation on this machine? In year ending 31st March 20x8, you need to calculate the depreciation amount. Witherby company purchased a machine on 1st July 20x7. Our year end is 31st March 20x8. When it was started, 1st April 20x7. So during the year, they purchased a machine of 500,000. It is being depreciated on a straight line basis over its useful life of 10 years. Residual value is estimated at 20,000. So we can calculate per year depreciation. 500,000 minus 20,000 residual value divided by how much life? 10 years. So can you calculate per year depreciation? 40,000. Okay. On 1st January 2008, following a change in legislation, whereby company fitted a safety guard to the machine. The safety guard cost 25,000 and has a useful life of 5 years, no residual value, mean there are two assets. So out of these 48, how much we will charge from 1st July 2027? So July, August, September, October, November, December, January, February, March, how many months? 1, 2, 3, 4, 5, 6, 7, 8, 9. What's the amount for 9 months? 36,000. And the other asset is of 25,000, no residual value, but 5 years alive. And for how many months we have used from 1st January onwards? So January, February, March, 3 months into 3 by 12. 5,000 into 3 by 12. How much? 1250. 1250 altogether. 37 250. So 37 250 is the amount of depreciation. Easy. It's financial accounting rather than financial reporting. F3. Question 32. What will be depreciation charge in relation to this machine in the financial statements of Auckland Company for the year ending 31st December? Good luck, everybody. I need answer for 32. You need to calculate depreciation. Online student, I need depreciation amount. Mr. Hassan Ali, are you there? Online people, I need answer. For sure, it's a resource. This is a bit technical because you need to calculate depreciation per month rather than per year. Because at the time of revaluation, you need to calculate carrying value using pro rata basis. If we assume complete year as 100%, this means 3%, we can say 0.25, 0.25 year, 6 months, 0.5 year, 9 months, 0.75 year. So you can calculate like that, convert the depreciation into per month, and then charge according to month. Ethan, I need answer. No, no, I don't know. I'm the vigilator now. Okay. Online students, give me answer. Are you there?
Yes, sir.
Give me the answer.
Sir, it's 4765.
4765. I need two more witnesses. Anybody with that different answer? Yeah. He is saying 4765. 12,692. Anybody with different answer? Or I need two more witness with either of these answer. At least three witness should be there in it. Come on. 5,940. 5,940. Come on. 48. 48. Come on. Okay, there are three answers.
476.
4765. I have two witnesses. Online student, Mr. Hassan Ali. Mr. Rakib. Ragi.
12,800, sir. I got
Sorry?
12,800.
One
Sir,
to
my
eight
answer is
hundred.
12692.31.
12692. We are having two witnesses for this, two witnesses for this. I need one witness more, either for 4765, either for 12692. Let's see. Auckland company purchased a machine for 60,000 on 1st January 20x7 and determined that it had a useful life of 15 years with nil residual value. This means 60,000 is the machinery cost and useful life is 15 years. So 4,000 is per year depreciation. Okay. On 31st March 20x9, they use the machine for the complete year of 20x7, complete year of 20x8, and 3 months, 3 months of 20x9. Yes. It was revalued to 64,000. But we need to make sure what is the carrying value at that. We need to make sure what's the carrying value at that time. So 60,000. For 20x7, the depreciation was 4,000. For 20x8, the depreciation was 4,000.
Yeah. 14
And for 20x9, the depreciation is 1,000. How we have calculated this 1,000? 4,000 into 3 by 12 or into 0.25. This means at the time of revaluation, its carrying value was 51,000. And its market value, they have 64,000. This means remaining amount went to revaluation surplus, but we need to calculate depreciation for the year 31st December 20x9. If we have revised its value, we need to calculate depreciation using the remaining useful life. This means this 64,000 should be divided by remaining useful life.
12.7.
If the original life was 15 years,
Oh, 12.7.
we use these two complete years, remaining 13. If we utilized 0.25, so remaining 12.75. You can convert into months,
Yeah.
or you can convert into months. For 12 years, multiply by 12, there will be 144 months. Plus 9 months, 153 months. So you can divide it by 153. And you can use either. Now what's the depreciation?
Yeah, 3,765.
3,765. So this is for 9 months.
Oh, mine is not for the first one.
This is for 3 months. So altogether, it is 4,765. 2 witnesses were there. Third witness, I am. So the correct answer is 4,765.
Only for one time.
They are asking about the depreciation for the year ended 31st December 20x9. So for first 3 months, we will charge this depreciation 20x9. And the remaining 9 months with the new value remaining useful life, we will charge this depreciation. So for the complete year, it will be 4,765. Only for the year ended 31st December 20x9, mean first this January x9 till 31st December x9. We are not asking about the complete life depreciation. Got it? Online students? Question 33, please. What amount will be shown in revaluation surplus at 31st December 20x8 in respect of the building? Good luck, everybody. You need to calculate revaluation surplus. One person is saying 0. Valuation surplus in respect of this building. Partner company vacated its head office building and let it out to a third party on 30th June 20x8. We need to calculate revaluation surplus at 31st December 20x8. So they were using in the office before 30th June as a property, plant and equipment. The building had an original cost of 9 lakh. On 1st January 20x0 they bought and was being depreciated on a straight line basis over 50 years. This means 900,000 was the cost for 50 years. They were depreciating in previous 7.5 years. But how much is the amount? 18,000 every year was depreciation. Okay. It was judged to have a fair value on 30th June 20x8 of 950. This means till 30th June, we need to calculate its carrying value. So 900,000 is the cost. So we need to charge depreciation. So depreciation we need to charge for how many years from 20x0, 1, 2, 3, 4, 5, 6, 7, and half of 8 years.
Yes.
So how many years? 8.5. Anybody is confused how we have calculated 8.5 years? See, 20x0, 1, 2, 3, 4, 5, 6, 7. How many years? 1, 2, 3, 4, 5, 6, 7, 8.
Oh.
And you used half year of 20x8 as well. So what's the cumulative depreciation?
153.
153,000. By deducting this, we arrived at carrying value of how much?
747.
740?
7.
7,000. And you revalued to how much? 950,000. So what's the remaining revaluation surplus? From now onward, it will not be depreciated. They are asking about revaluation surplus. Because till 30th of June, it was used as property, plant and equipment. And while transferring from PPE to investment property, we need to revalue. And they have given the market value. So 203,000 is the revaluation surplus that they have asked for. At the year end date, 31st December, the fair value of the building was estimated 1.2 million. But at that date, it was investment property. If the fair value has gone up to 1.2 million instead of 0.95, there is revaluation gain, but that will be charged to profit and loss account because that is relating to investment property.
So revaluation surplus.
Revaluation surplus is up to 30th June.
Okay.
Though from here it is at the year end become this. But we will not charge the revaluation surplus from here to here because it is now investment property.
So revaluation surplus can only be till it is being used as PP.
It has a PP. Is that fine?
Yes,
Shall we move forward? Online students, any issue? They're not responding, they are sleeping.
No, no, sir.
Okay. Thank you for reply. 34. Subsequent to initial recognition, investment property held at a fair value are not depreciated. This is the rule. Okay. Which of the following is a valid justification for investment property held at a fair value not being subject to depreciation? While property, plant, and equipment held at a fair value is subject to depreciation. Meanwhile, investment property should not be depreciated if recording on fair value basis. What is the valid reason? Investment properties don't generate income to match against any depreciation expense. No, they generate income. Why we have invested to generate income? So this is wrong. You cannot reliably measure the useful life of investment property.
You can.
We can investment property, if it's a building, we can measure. Investment properties never decrease in value.
They can.
They can decrease in value. If market goes into slump, their value will be decreased. An investment property is likely to increase in value. Likely mean there are more chances the value normally increases because they are generating revenue. So any residual value would be greater than its carrying amount. That's why we don't need to depreciate when we are recording on fair value basis. Those property values increasing day by day, not a decrease.
Yeah.
Property will give you benefit in future. Always give you benefit in future. There are very less chances you will be having loss in. Wait till 20 years. It will increase, might be more than 1000%. Okay. Question 35. Now we are moving towards intangibles. Sagan Company, what you need to do? How much should be recognized as an expense in the statement of profit or loss for the year ended 31st December 20x5 in respect of each item? There are two items, brand amortization and training cost. How much should be recorded as expense? Sagan Company acquired a brand name with an estimated useful life of 10 years on 1st January 20x2 for 10 million. Should be amortized because they have purchased and its useful life is 10 years. How much is the life? How much is the amount? 10 million. Using for 10 years. So 1 million is the annual amortization. On 1st January 20x5. What's the year end? 31st December. On 1st January 20x5, a brand specialist believed the brand to have a fair value of 14 million. Who is the same? Brand specialist. We need to use active market values rather than any other value. Brand specialist, is that active market value? No. Sagan company also ran a accounting training course. Mean from here onward, training information is given. So what should be recorded as brand amortization? Either based on 14 million or either based on 10 million.
Okay.
10 million. Why? Because 14 million is not an active market. We can decrease the value of intangibles using impairment or amortization. But we cannot increase value until we are having active market value. So this will be 1 million. So Sagan company also ran a training course on 1st January 20x5 for all staff on how to use a new software system. The training cost Sagan company 450,000. On average, the employee are expected to remain with the Sagan company for 3 years. Is that intangible asset? They have trained the employees and they are expecting they will remain in your business for next 3 years through this training. So this training will provide future benefit. No, you cannot assure employee retention, especially for 3 years. For 1-2 day, even you cannot say they will be retained. Might be they will left the very next day because they are having more skills. So this full cost should be treated as expense, as a research cost, or as a revenue cost. Revenue nature is not capitalized, it's revenue nature. There is no link of research or development cost. So 450 should be treated as expense in profit and loss account, and they were asking about how much amount should be recorded in profit and loss account. So this should be recorded as amortization. This should be recorded as training cost, mean this and this. Is it fine? Question 36, please. Good luck, everybody. We are asking about what amount will be charged to profit and loss account for the year ended 31st December 2018 in respect of research and development cost. All research cost should be expensed out to P&L. For development cost, either any impairment or amortization will be expensed out. So Asoria company had 20 million of capitalized development expenditure at a cost brought forward at 1st October 20x7, mean from previous year, they are having a 20 million as a development cost. If it is meeting criteria in the same current year, it will remain as priced in respect of the product currently in production. But we need to amortize it. If there is no addition, we need to amortize it in the current year. A new project began on 1st October 2007, start of this year. The research stage of new project lasted until 31st December 2007 and incurred 1.4 million of costs. So straightway this research cost of 1.4 million, this will move to profit and loss account. From 1st January 20x8, the project incurred development cost of 800,000 per month from 1st January onward. On 1st April 20x8, the directors of Associa company became confident that the project would be successful and yield a profit well in excess of cost. They started incurring cost from 1st January. But for the first 3 months, director was not confident whether this will meet the development criteria or not. So they realized from 1st April, okay, this will meet the development criteria. This means the cost incurred 800 per month from January to March. For 3 months, that will also be treated as research cost. How much? 800,000 into 3 months, that will be
2.4 million.
2.4 million.
So even though they said development costs, we don't have to capitalize.
Exactly. Okay, the project was still in development at 30th September 20x8. And still in development. If not developed, not used, there will be no amortization relating to this amount. And there will be development cost from 1st April till 30th September. For how many months? April, May, June, July, August, September, for 6 months into 800, we will capitalize as development cost. But that will not be amortized. What will amortized? Only this. Because of their usage, even nothing has been developed. We need to start amortizing from the date the usage is started. So capitalized development expenditure is amortized 20% per annum. So what is amortization? That will be charged to profit and loss account. 20 million into 20%. That will be 4 million. So altogether, what is profit and loss account figure? Option C, 7.8 million.
At what point you start amortizing?
When asset is available for use. When we start getting benefit of that development cost. If it is not completed yet, this means we are not using it. We are not selling it.
So because it's currently in production, we can amortize. The second one we.
If suppose it is completed on say 31st of August. This means from 31st, after 31st August, we are getting benefit of this development cost.
Yeah.
This should be amortized. If it is not completed, this means if it is not completed, we are not using it, we are not selling anything from it, so we are not getting benefit. Is that? Okay. Let's move forward. 37. Identify whether the following internally generated items are eligible or ineligible to be recognized as intangible asset in accordance with IAS 38 intangible asset. Ignore the effect of business combination, whether they are eligible for capitalization in asset or not eligible. A customer list built up over the last 10 years of trading updated for the customer current preferences. We discussed in the book, this is ineligible. Internally generated.
Hmm.
Specialized tooling for a new product developed by the business. Specialized tooling for a new product developed by the business. So this is development cost. It should be recorded as intangibles. A working version of a new machine that uses new technology used for testing of the prototype apparatus.
Yeah.
Yes, it is development cost. Prototype mean sample they have produced. A title heading, font and design of the front page of a major broadsheet newspaper, masthead that we used. Ineligible. We have covered all these points in book 38. What should be the carrying amount of the brand in the statement of financial position of the company at 30th September 20x9? Good luck, everybody. You need to calculate the carrying amount of the brand. You need to calculate carrying back.
Mhm.
At 30th September 20x9, Sand & Company's trial balance showed a brand at cost 30 million and accumulated amortization on that brand brought forward at 1st October 20x8 of 9 million. When at 30th September 20x9, 30 million was the trial balance cost and 9 million was the accumulated depreciation at start of the year. This means carrying value was how much? 21?
21.
Okay. Amortization is based on a 10-year useful life. An impairment review on 1st April 20x9 concluded that the brand had a value in use of 12 million and a remaining useful life of 3 years. When at 1st April 20x9 during the year. However, on the same date, Sand & Company received an offer to purchase the brand for 16 million and cost of 1 million would be incurred in a legal fee associated with the sale. What is the recoverable amount?
Okay.
How? Its value in use is 12, higher of value in use and fair value less cost to sell. What is fair value less cost to sell?
60.
50.
15 million.
So its recoverable amount is 15.
Yes.
When at 1st April 20x9, mean there could be some impairment loss that was recorded in profit and loss account. We don't need to calculate that. We need to calculate carrying value. This means its value being recoverable amount is 15 million now. From this, we need to deduct amortization. How much is the remaining useful life? 3 years. Supply amortization. 15 million divided by 3 years. How much is that?
5.
5. And how many months from 1st April onward till 30th September? April, May, June, July, August, September means 6 months. How much is the amortization?
2.5.
How much is the amortization?
2.5.
2.5 million. So carrying value is you're not asking about what is the impairment loss or what is the amount before that. Now, good luck everybody with question 39, please. Select your answer from the option below and place them in the blank boxes. Is there any options? Yes, there are options.
That's fine. You can just zoom in, others we can't read.
Yeah, don't need the options. Calculate the amount. Carrying amount of intangible asset at 31st September 20x5, carrying value, and amount charged to profit and loss account for the period 31st September. Good luck, everyone. What should be charged to profit and loss account? What is the carrying value? No.
Okay, for one.
Suppose there are no options. What is carrying value?
Carrying by 287.
80,000.
172.
172. Both are wrong.
Ah.
Ethan, what is carrying value?
152000.
152. He's saying 152.
Oh,
And what is the amount charged to profit and loss account?
240.
88000.
80, 240, 80. Ethan, what is the amount charged to profit and loss account?
88000.
88,000.
yeah.
Yeah.
Now, let's see. So Dempsey Company year end is 30th September 20x5. Dempsey Company commenced the development stage of project to produce a new pharmaceutical drug on 1st January 20x5. Expenditure of 40,000 per month was incurred until the project was completed on 30th June 20x5. So project completed on 30th June. From this date, amortization will charge. For how many months? If year end is 30th September, July, August, September, 3 months. When the drug went into immediate production, the directors became confident of the project's success on 1st March 20x5. Mean before this, all costs should be charged as research. Means see, they started on 1st January. Year end is 30th September. And on 30th June, project completed. Mean after this period, we need to charge amortization. Not before that. And on 1st March, directors was confident, okay, we gonna complete this. Mean from 1st March onward, all costs should be treated as research. From this time to this time, cost should be charged as development cost mean intangibles. 40,000 per month. This means January and February. So 40,000 into 2, 80,000 will be our research cost. That will go into P&L. The drug is expected to generate benefit for 5 years. Useful life is 5 years.
30,000 annually.
So this means March, April, May, June. 4-month cost. What is per month? 40,000 into 4 months. 160 will be development cost. What will be the amortization? 160 is the total amount divided by 5 years. How much? 32,000. How many months amortization we need to charge? July, August, September. 3 by 12. What is that amount? 8,000. So carrying value will be 160 minus 8,000. How much is that? 152,000. And what will go into profit and loss account? This 80 plus this 8 all together 88,000.
I got 108.
No, your answer was incorrect. Whatever are the excuses. Okay, now moving towards impairment questions. Question 40. Good luck, everybody. Good luck, everybody. Question 40, please. What will be the carrying amount of a building this asset after the impairment loss has been recognized? Mean by deducting the impairment of building, what will be the carrying amount? The impairment we need to eliminate from goodwill first. No amount should be deducted from current assets and remaining asset pro rata basis. But there is some information about plant as well.
Yeah. Mm.
Come on. We have covered two similar questions in previous class. That question, there was technology that we eliminated fully first. Now you need to eliminate goodwill first and then plant by this amount first. The remaining should be based on pro rata. See. So they are having four assets: building, plant, goodwill, current assets. Their carrying value is 110. Following an impairment review, it was discovered that an item of plant carried at a 40,000 is damaged and will have to be scrapped.
Yeah.
This should be eliminated first. The recoverable amount of the cash generating unit is estimated 750. So recoverable amount is 750. What is the impairment required? 1010 minus 750? 260. 260 impairment is required. Okay. Out of this 260 impairment. And after that, remaining carrying value. So what we need to do, we need to eliminate goodwill first. We need to eliminate 40 from the plant. There shouldn't be any deduction from current assets. They will remain same.
Yeah.
Goodwill will become 0. How much we are having left from 260? We have eliminated a 90. We have eliminated 40. How much is left? 130. That 130
We deduct from rent.
will be deducted from building that is of 700 and plant of how much? Not 200, 160. Altogether how much? 860. This means for this 130 into 700 divided by 860. How much is that? How much is that?
106.
106.
Let's see.
106. And by deducting 700, 106, what is the amount? 594.
Yes.
500.
Do we need to calculate for plant remaining? No. Simple, move towards option C. Question 41. Complete the statement using the option provided. Select your answer from the option below and place them in the blank boxes. The recoverable amount of an asset is higher of. What are the options? Fair value? No. Fair value less cost to sell and value in use. This was recorded mountain. Now, good luck everybody with question 42, please. I assume you people have studied management accounting. You know how to calculate value in use if future benefits are given. You know how to calculate discount factor. Yes. You have learned NPV.
I know how to, yes, I know how to give us a point.
Value in use.
Right.
Present value, future benefits.
Yeah, that I know.
You need to calculate impairment loss by comparing carrying value with recoverable amount. Carrying value is given in the question. So Lichin company owns a machine that has a carrying amount of 85,000 at the year end 31st March 20x9. Its market value is 78,000 and cost of disposal are estimated of 2,500. 78,000 fair value less cost to sell 2,500. It is 75,500. Okay. New machine would cost 150,000. The company expect it to produce net cash flows of 30,000 per annum for the next 3 years. The cost of capital is 8%. And through this data, we can calculate value in use. Value in use. For year 1, year 2, year 3, we are having cash flows of 30,000. And on this, we need to apply the discount factor. How to apply the discount factor? We can calculate 1 divided by 1.08 raised to power 1. 1 divided by 1.08 raised to power 2. 1 divided by 1.08 raised to power 3. And if we calculate on the calculator, 1 by 1.08, the answer is 0.9259. 0.926. For next, just put the equal to sign again. It will give you value 0.857. For next, just put the equal to sign again. It will give you value 0.794. For remaining year, just put equal to equal to equal to equal to, they will give you value. Don't need to calculate part 2, part 3, part so many. So 30,000 into 0.926, what's the value? 27778. And 30,000 into 0.857? And 30,000 into 0.794, 23815. By adding all these, we will be having value in use 77,313, and we are having a fair value less cost to sell, and that is 75,500. What is higher? 77, and our carrying value is what? 85,000. So by comparing both of these, we can calculate impairment loss of how much? 76? 87. So what they are asking about? Anybody with a different answer? Or do not agree with me? They can raise hand so that I can shoot them. Done? Okay. Question 43. IAS 36 impairment of assets suggest potential indicators of impairment. Which two of the following would be external indicators that one or more of an entity's asset may be impaired? And you need to identify external, not internal. Two, an unusually significant fall in the market value of one or more asset. Market value where? In the market. Is that market internal or external to the business? External. Evidence of obsolescence of one or more asset. Internal. A decline in the economic performance of one or more assets. Internal. An increase in the market interest rate used to calculate value in use of the asset. Interest rate increasing, discount factor increasing will result into more impairment. Decrease in interest rate will decrease the discount factor. There will be indication of reversal of impairment. Okay, question 44. Good luck, everybody. What is the amount of the impairment loss that should be recognized in respect of the plant? Very simple. Carrying value, recoverable amount. Recoverable amount is a higher of fair value less cost to sell and value in use. $350. Why? This carrying value is 3 million. 3 million is a recoverable amount. They have a offer mean fair value 2.7. And its value in use is 2.6, higher is 2.7, but we need to bear our cost as well. So 2.7 minus 50,000, even it will be 26, 2.65 thousand. So impairment is required with how much amount? 350,000. Simple. 45. Okay, see, a business which comprises a single cash generating unit has the following assets: goodwill of 3 million, patents of 5 million, property of 10 million, plant and equipment of 15 million, net current assets of
2.
2 million, altogether 35 is the carrying value. Following an impairment review, it is estimated that the value of the patent is 2 million. Is 2 million. What was before? 5 million. So this means impairment goodwill will be complete 3. And from here,
3.
you cannot zoom more than this.
Yeah, okay, this is
So impairment will be 3.
3.
Because after that goodwill will be 0 and this will be 2.
2.
And the recoverable amount of the business is 24. Is the recoverable amount is 24. This means impairment needed is of 11.
No. Okay.
And we need to calculate the carrying amount of property. So from this, there will be nil. This will remain same. If we have deducted 3 for goodwill, 3 for patent, so remaining is a 5 that we need to charge to property and plant and equipment. Property and plant both 25. So for property will be 10 by 25. How much is that?
2.
2.
2 million.
They are asking about property. What is the carrying amount of the property? Carrying amount of the property. So 2 million. So by deducting 2 million from here, we will be having 8 million carrying amount. So carrying amount is 8 million. Is there any option?
1. 3.
Easy. If amount would be charged to profit or loss for the impairment of the asset for the year ended 30th September 2024. Calculate impairment, please. Impairment loss. Good luck. They have given you anti-factor to calculate value in use. Instead of applying discount factor every year, simply multiply this with the cash flows per year. We need to compare carrying value with the recoverable amount, not the cost. Mean at the time of impairment, we need to calculate carrying value of the asset. What's the carrying value? Its cost was 100,000. What's the per
50,000.
year depreciation? That is 10,000. Yeah. And depreciation from 1st October till 31st September 20x 0. 1 year. 20x 1, 2, 3, and 4. How many years? 5 years. So depreciation will be for 5 years, 50,000. So carrying value is 50,000. Is that okay? Its fair value less cost to disposal is 30,000. What is value in use? They will generate 8,500 each year for next 5 years. And discount factor is 3.79. What's the value? 8,500 into 3.79.
32,215.
32,215. What is a higher? This is a higher. So recoverable amount is 32215. So what's the impairment loss?
77.
17,785. Is that? Okay. Next question.
Sir, can you tell again how to calculate in 5 years?
5 years. It started from 1st October 20 W9. After W9, there will be W0. So 20 W9, W comes before X. So there will be, you can say X0, X1, X2, X3, X4.
W is 2009.
Mean
14.
1st October, this will start from here and end on here. So this 1 year depreciation. X1 1 year depreciation, X2, X3, X4, 30th September, X4. How many years? 5 years. We will not add that for 20W9 because that will start from X8. Okay. 47. What you need to do? What would be the carrying amount of Finger's property, plant and equipment after the allocation of the impairment loss? Carrying amount of PPE. The net assets of company, a cash generating unit, property, plant and equipment of 200,000, goodwill of 50,000, product patents of 20,000, net current assets are 30,000, carrying value is 300,000, and impairment review was carried out following adverse publicity received. The impairment review indicates that a company has a recoverable amount of 200,000. How much is the total impairment required? 100,000. Out of this 100,000, we will eliminate goodwill first, 50,000. So remaining 150. Remaining 150, we need to allocate against two assets to 20,000. And we need to find for property. So 150 is remaining. That will be charged 200,000 divided by 220,000. So what's the amount? Of impairment? And then we can calculate amount of carrying value. What's the amount of impairment for this? Is equal to 150,000 into 200,000 divided by 220,000.
3636.
Come on.
One
But-
piece. 36.
13636. Oh, sorry. It's not 150, it's 50 because total is 100,000 in it. So 50,000 into 200,000 divided by 220,000.
4, 5, 4, 5, 5,
4, 5, 4, 5,
5.
4, 5, 4, 5.
It's repeating 4 5s.
Yeah.
So 4, 5, 4, 5, 4. So the remaining carrying value will be 1, 5, 4, 5, 4.
It's
1,
false.
1, 5, 4, 5, 4, 5.
Yeah, 1.
Is that
Yeah.
okay? 48. Select whether each of the following statement is an indicator of impairment or not an indicator of impairment as per IAS 36. Advances in the technological environment in which an asset is employed has an adverse impact on its future use. Is that indicator or not? Yes, required. An increase in interest rate, which increase the discount rate of an entity uses. Yes, increase is an indicator, decrease is reversal. The carrying amount of an entity's net asset is lower than the entity's number of share in issue multiplied by share price. Mean if net assets value is lower than company share capital, this means there is an indication of impairment because whatever the amount invested in the business is not having that worth. So this is something new. Carrying value of net assets is lower than share capital in case we need to impair the asset, mean they are not equal to the amount of investors. This means your asset worth is lower. The estimated net realizable value of inventory in an inventory is excluded from impairment. So this is not an indicator. So let's take a break. After break, we're gonna start new chapter.
Can you go up to the second last one?
The carrying amount of an entity's net assets is lower than the entity's number of shares in issue. Multiply its share price called share capital.
So this means
Mean if net assets are lower than equity. Net assets mean total assets minus current liabilities. Net assets mean total assets minus current liabilities. Not only asset. Net assets mean total assets minus current liabilities. If its value is lower than equity, there is an indication of impairment, mean whatever the amount invested into the business, their asset is not having that worth. This means business is not generating that much. It is an indication of impairment.
always
This is another indication of impairment, though we haven't studied in the book, but this is an indication we will study in SBR. Something new.
yeah,
This is new point.
like all the big companies, they have share capital of like trillions, but their assets are not in trillions.
Assets are equal to equity plus liabilities.
I searched online, Apple's net assets is in billions, but the share capital is in trillions. So share capital is higher than net assets. But I think it's like it's not a always rule, it's a general rule.
General.
That's-
So let's have a break. After break, we will discuss a new chapter. Coming in 15 minutes.
And others and it's not. Mm. Um, it's on the line. Yes. Where is it? Not for the moon. Not only. Paratha, chai or no, a paratha with sausage, egg, cheese. You know how to cook. Yeah. What? At home, I don't really care that much. When I was in one, I wanted to take a lot. Means oven baked pasta, maybe potato, no, oven baked potato, then chicken chili, butter chicken, then beef chili, then prawn butter masala, then uh, Mexican fried then sushi, then um, Constant veg as well. Sushi what? Consider a form of veg as well. Yeah. Right? Then what else? Now it's simple. Then mm, pizza. Crab rangoon. I don't remember. Chicken tikka. Then beef kebab. Chicken pork. Yeah, chicken pork. I have not tasted, but I have eaten in the restaurants. I have now. I tried like making. I haven't tried making, but yeah, obviously. Fish fry. It's very easy. Fried fish. 41. So easy. Yeah. My goodness. Actually, ah, I feel like my liver is in the bottom. Mm, what mom will I break? What's mom? I got to forgot. Yeah, even I thought you forgot that. So I was waiting one sir will give break, one sir will give, then the next question, next question, next question. It's like I can't watch it. So I just go, the flow made actually the thing is I finished all my tea. So I had to go to watch. You want cold water? You want cold water? I want. I will. I will drink. No, it's fine. I will drink it. Just it's fine. It's fine. I will go. Okay. Okay. Friends. Have some. I will be there. Even drink cold drinks. Very rarely. What? Game house. Okay, if you are watching, like, you don't have any apartment taking in England. Okay, so I want to shift in July for a house. Just tell them in advance that if there is any vacant or any adjustment for August, we need to share. So there is one studio area. I'm going to submit it. Mm, Right to you. Right.
Okay, let's start
2000.
new chapter
Right. 45.
5.
I'm going to do it's on the issue. Okay.
So the name of chapter 5 is non-current asset held for sale and discontinued operation. Non-current asset held for sale and discontinued operation. So non-current asset held for sale and discontinued operation mean this chapter is covering two things. One is asset held for sale and the other topic is discontinued operation. And there is one accounting standard IFRS 5 that is covering both these things, non-current asset held for sale and discontinued operation. Let's discuss what is a non-current asset held for sale. If company is going to sell its asset and that asset is a significant from financial statement point of view, significant asset. The value of the asset is more than 10% of total assets. Greater than 10% of total assets. So that will be called significant asset. And if company going to sell its significant non-current assets, you need to provide a disclosure in the financial statement. You need to separately classify that asset. Separate classification of that assets where in current assets. Mean you need to shift from the head non-current assets to current assets. Because in non-current assets, we state only those assets that are providing benefit more than 1 year. Now we are going to sell this asset. So we need to exclude from non-current assets and include where under current asset, and we will name it held for sale. And no depreciation should be charged. Obviously, depreciation we need to charge on non-current assets. If it is moving towards current assets, so there will be no depreciation on this asset. So this is the accounting treatment for non-current asset held for sale. And if company going to dispose, sell its significant non-current assets, significant mean contributing 10% or more of total assets. So you need to provide separate disclosure in the financial statement. You need to separately classify that into current asset, and depreciation should be ceased. Mean no depreciation means ceasing depreciation. Either you are selling that asset in the current year, this accounting treatment will be applicable on the current year financial statements. Or if you have made a decision in current year, but you're gonna sell this asset in next year or in next 12 months even, this accounting treatment will be applicable on the current year financial statements. Company year end is 31st December. Company is going to sell this asset in April next year. But if they have made a decision in current year, they need to apply this accounting treatment in current year financial statement. Is that fine? What is the discontinued operation? We will discuss later on. Let's discuss asset held for sale first. So accounting standard is IFRS 5. So the objective of IFRS 5 are set out below. Requirement for the classification, measurement, and presentation of non-current asset held for sale. And if you are excluding this asset from non-current assets and you are going to include in current assets, its value will be measured lower of carrying value and fair value less cost to sell. In NRV in simple word. Because in current assets, how we value the inventory, that is lower of cost and NRV. But asset held for sale, what's the criteria to recognize it? Carrying value, lower of carrying value, or fair value less cost to sell. Fair value less cost to sell, and fair value will be measured using active market. Fair value will be measured using active market. So requirement for the classification, measurement, and presentation of non-current assets held for sale, in particular requiring that such asset should be presented separately on the face of statement of financial position. And what is relating to discontinued operation, we will discuss later on. So classification as held for sale. What does that mean? An entity shall classify a non-current asset as held for sale if its carrying amount will be recovered principally through a sales transaction rather than through continuing use. If business going to receive any money by disposing of the asset, then it will be called held for sale. Business will no longer gonna use this asset. They have decided this. For this to be the case, the following condition must apply. The asset must be available for immediate sale in its present condition. If you need to perform some work on the asset that will require further cost, then this standard will not apply. In the same condition that is available for sale. The sale must be highly probable. Probable chances must be more than 50%. In fact, more than 75%, highly probable. Meaning that management are committed to plan to sell the asset, they have decided, they have discussed in the meeting, they have shown their intention, decision have been made in the current year. There is an active program to locate a buyer, mean there is some price offer from active market. And the asset is being actively marketed at a price that is reasonable. Marketed means going to be sold. The sale is expected to be completed within 1 year from the date of classification. Mean its sale must be within 1 year. If sale will be after 2 years, then you cannot classify it as held for sale in current year. Might be next year you will apply this time. As held for sale, it is unlikely that significant changes to the plan will be made or that the plan will be withdrawn. Mean if you have decided, you will sell this asset. There shouldn't be any confusion. Oh, might be we can use this asset. No. Measurement of non-current asset held for sale. Non-current assets that qualify as held for sale, mean according to above criteria, should be measured at the lower of carrying amount, fair value less cost to sell. Mean its value will be written in under the head current assets by checking what is lower of carrying amount and fair value less cost to sell. Held for sale non-current assets should be presented separately on the face of statement of financial position under current assets and not to be depreciated. Where assets held under the revaluation model are reclassified as held for sale, these assets should be revalued using the method IAS 16 or IAS 40 as appropriate prior to reclassification. Mean they need to be revalued before moving towards current assets. As to understanding one. At what value should the machine be stated in Michelle Company statement of financial position as at 31st December 2023? Good luck, everybody. Can you calculate the amount at which this asset should be recorded under current asset? What amount this asset should be recorded under current assets? Lower of carrying value and fair value less cost to sell. Carrying value and fair value less cost to sell. Year end 31st December 2023. In 1st January 20x1, Company bought a stamping machine for 20,000. It has an expected useful life of 10 years and a nil residual value. 2,000 is the annual depreciation. On 30th September 2023, company decided to sell the machine and start actions to locate a buyer. The machine are in short supply, so company is confident that the machine will be sold fairly quickly. Its market value at 30th September 2023 is 13,500 and it will cost 500. So 13,000 is the fair value less cost to sell. And till 30th September, it's a carrying value till 30th September 20x3. So 2020x1 will be complete used. 2020x2 complete used. And 9 months mean 0.75 of 2000 mean 1500 used for 20x3. So 20,000 is the cost, 2000, 2000 and 1500. If we find what is that, 14,500 and lower is 13,000. So 13,000 will be the amount for recording this at 30th September, where under current asset. Okay. The machine are in short supply, so company is confident that the machine will be sold fairly quickly. Its market value at 30th September is this. To dismantle the machine and make it available for purchaser, the machine had been sold at the year end. What will the carrying amount at 31st December 20x3? At 30th September, its value become 13,000.
Or the 14,000.
What is the lower amount? Carrying value and say fair value less cost to sell. So this is the lower amount. At 30th September, this will be recorded at this amount. Do we need to charge depreciation for the 3 months? No. Why? Because this is asset held for sale. At year end, its value will be 13,000 in the balance sheet. Now moving toward discontinued operation, the second topic. If business, suppose our business is having 3 different operations. Our business is having 3 different operations. From this business operation, suppose we are generating 20 million profit. From this, suppose we are generating 30 million profit. And this third is loss making and we are making 40 million loss from this operation. If we keep all these 3 operations, at year end, we are showing 10 million profit. But business has decided the loss is huge. We should discontinue this operation. Because is eating the profit of these operation as well.
Yeah.
I mean, if we discontinue this, our profit will be 50 million.
Yeah.
So they have decided to discontinue this operation. If you have decided to discontinue any of the operation, you need to show it separately. And you need to provide a disclosure in financial statement regarding its revenue, what revenue you are generating from it, regarding its cost, and regarding the profit or loss. Now, if you have decided to discontinue any of the significant operations, significant means that contribute to revenue either 10% or more, or to profit 10% or more, so that is significant business operation. Now, you while preparing your profit and loss account, you will show the continued operation results first, like it's a revenue, it's cost of sale, it's a GP, it's a operating expenses, and its profit. Then you need to show discontinued operation, discontinued operation, only the profit or loss. And then the net profit or loss. I mean, don't need to include this in your total profit. Try to show it separate. First, you need to show the continued operation so that the user of financial statements can see what are the profit or loss from business normal operations. And for this discontinued, what business is generating either profit or loss, that is separate. And how this profit or loss has been calculated, the detail we will provide where under notes to the accounts. And there are 5 components of financial statements. Statement of profit or loss account, statement of financial position, statement of cash flow, statement of changes in equity, and notes to the accounts. So in notes to the accounts, we provide disclosure about asset held for sale. And in notes to the accounts, we will show the calculation of profit or loss for this discontinued operation. Is it fine? Again, if business has decided in current year to discontinue operation and operation going to be continued after year end, this standard will be applicable on the current financial statement. Either you are discontinued in the current year or even after year, but you have decided in the current year, this standard is applicable on current year financial statement. Okay, let's discuss. A discontinued operation is a component of an entity that has either been disposed of or is classified as held for sale. Either business going to sell this business part or you are going to wind up this business part. Represent a separate major line of business or geographical area of operation. Might be your business is operating in 5 different geographical area, and this is one of the area where you are not incurring as much profit as you are earning in other areas. Might be the circumstances, the environment, the market is not that much helping in that area. Our discontinued operation is a part of a single coordinated plan to dispose of separate major line of business or geographical area of operation. Or it could be any of the subsidiary of your business is a subsidiary acquired exclusively with a view to resale. In you found in a market, somebody is going to sell its business. But you realize it's a good investment opportunity. After buying it, we will a little bit improve it and then we can sell at a high price. So you bought the subsidiary for resale purpose, mean after treating the machinery, after repairing that subsidiary, might be we will be able to sell at higher price. So that will be called discontinued operation. Mean don't need to consolidate its subsidiary, show the result of the subsidiary separately. Because your intention is not to keep the subsidiary in future. Your intention is to sell at high price in future. So by showing the performance of discontinued operations separately, user can see the performance of the remaining operations. That's why we are showing profit of a continued operation separate and discontinued operation separate. So that user can see, okay, wow, what business is having from their normal operations. enabling them to predict the future performance more accurately. Because if we include all the results, it is showing 10 million profit only. If we exclude it, it's showing 50 million from continued and 40 loss from discontinued. So an entity must disclose a single amount on the face of statement of profit or loss comprising the total of post-tax profit or loss of discontinued operation. Mean we just need to show only the profit or loss relating to discontinued operation. It's a revenue, it's cost, we will disclose where in notes of the accounts. We don't need to include its results in other operation. Is that fine? Or the post-tax gain or loss recognized on the measurement of a fair value less cost to sell or on the disposal of the asset continuing the discontinued operation. Mean if there are any assets relating to this operation, that will be shown as held for sale. Because if we're gonna wind up this operation, we see asset relating to this operation, we will sell. So those assets, obviously we are not going to use them in future. So we will classify from non-current to current assets, mean on them held for sale accounting treatment. An analysis of this single amount must be presented either in the notes to or on the face of the statement of profit or loss account. I mean, there are two options. Either you can show the profit and loss separate of this discontinued operation here. I mean, these all things relating to discontinued operation will be shown here, or just show the profit or loss here and put a note, say 3, mean its detail is given in note 3, where notes of the accounts. The best treatment, just show a single line profit or loss and detail should be provided in notes of the accounts. So an analysis of this single amount must be presented either in the notes or on the face of statement of profit or loss account. The analysis must disclose, mean what you need to provide in the notes, how you calculate the profit, mean the revenue, the expenses, pre-tax profit, loss of discontinued operation, related income tax expense, the gain or loss recognized on the measurement of a fair value less cost to sell or on the disposal of the asset constituting the discontinued operation. And if you are selling asset relating to this discontinued operation, any gain or loss on the disposal of asset should also be included in the detail of this discontinued operation. Is that fine?
Suppose one of the operation, the profit is very low, like only 10% or 15%. So if I want to discontinue it and expand my other two operations, like I can do that.
Yeah, you can do that. You can do that, but whatever you are discontinuing, that you need to show separately
Okay.
if it is significant. Okay. So how the profit and loss account will be prepared for continued operation? We will show the revenue, cost of sale, gross profit, then operating expenses, distribution, admin expenses, profit from operation, its finance cost, profit before tax, income tax, and profit for the year for continued. Then we need to show the discontinued operation profit for the period and total for the period by adjusting this. Instead, we are including all the results of discontinued operation in that. We are showing continued operation results separately and discontinued operation separately. The analysis of the single amount as described above would be given in the notes. Mean detail of this will be available in the notes of the accounts. Test your understanding too. Requirement. Draft the statement of profit or loss for the year ended 31st March 2026. ST Valentine produces cards and sold roses. They sell cards and roses. However, halfway through the year ended 31st March 2026, halfway through the year ended 31st March 2026. The rose business was closed and assets sold off, incurring losses on the disposal of non-current assets of 76,000. That loss is relating to discontinued operation. And redundancy cost of 37,000. That is also relating to discontinued operation. The directors recognize the continuing business at a cost of reorganize the continuing business at a cost of 98,000. Obviously, if you are discontinued something, your existing business will also be affected. That you need to reorganize. So they bear 98,000 extra cost for their continuing operation reorganization. So first two costs are relating to discontinue, and this is relating to continue operations. Trading results may be summarized as follows. Revenue for continuing business is 650, cost of sales 320, distribution cost 60, admin cost 120. And for the discontinued operations are also given. Other trading information to be allocated to continued operation is as follows. This information is related to continued operation. Finance cost mean interest and tax is 31.
For both or only?
For continued only. There is no information for tax and finance cost of discontinued. So we need to prepare profit and loss account. So first, continued operation. Revenue. How much? 650. Cost of sale. How much? 320. We arrive at gross profit. How much? 330. And from this, we need to deduct the distribution expenses.
60.
60. From this, we need to deduct admin expenses.
150.
120. From this, we need to deduct reorganization expenses.
That.
That is 98. We are having
52.
profit before interest and tax. That is 52. And from this, we need to deduct finance cost. How much is that? 17. So profit before tax. That is, what's the profit before tax?
30.
35. From this, we need to deduct a tax of 31. We arrive at profit of 4. And then we need to find discontinued operation. And we need to see whether there is a profit or loss. And for that, we need to make separate calculations in notes to the accounts. So discontinued operation, revenue is 320. Cost of sale is 150. Gross profit is 170. Distribution cost are of 90. Admin cost are of 110. And there are some other expenses like there is a loss on disposal as well as redundancy cost. So redundancy cost of 37 and a loss on disposal that is 76, whether there is profit or loss.
143.
170 minus 90 minus 110 minus 37 minus 76. 143.
Yeah.
So we are having the loss of 143. So loss 143. So we are having a net loss of how much?
139.
139. Is it fine?
Mhm.
Explain how an IFRS 5 discontinued operation presentation can make information more useful to the user of financial statement. By showing separate result of continued and discontinued operation, user of financial statements will be able to know what business is generating from their normal routine business and what loss they were incurring through discontinued operation. Through this, they can predict business future in better way. If we don't exclude them separately, they will not be able to make a decision in better way. They cannot see how much business is generating, from where business is generating profit and from where business is generating losses. As your understanding 3, that you will cover by yourself. As your understanding 4. According to IFRS 5, non-current asset held for sale and discontinued operation, which two of the following relate to the criteria for an asset held for sale? Which two are the criteria for asset held for sale? The item must be major line of operation or geographical area. Major line of operation. The asset must be available for immediate sale.
Mhm.
Yes, immediate sale in its present condition. The sale is expected to be completed within the next 3 months. No,
By year.
next year. A reasonable price has been set. Yes. Number 2. According to IFRS 5, non-current asset held for sale and discontinued operation, which of the following amount in respect of discontinued operation must be shown on the face of statement of profit or loss account? Revenue, gross profit, profit after tax, operating profit.
Not operating.
Profit after tax
Um,
relating to discontinued operation. On face of your normal profit and loss account, what you need to show is profit after tax. Option 3 only or 2 only? 3 only. Number 3. According to IFRS 5, non-current asset held for sale and discontinued operation, how should non-current asset held for sale be valued? Law of carrying value and fair value less cost to sell. Option number 4. Good luck, everybody. Number 4. Is it relating to non-current assets rather than relating to the standard IFRS 5?
No.
Halfway through the year. Halfway through the year. It's not a name of company. It's an information. Halfway through the year, an asset is identified as an asset held for sale after meeting the criteria according to IFRS 5. The start of the year, the carrying amount of the asset was 150. Original cost 200,000 2 years ago. This means previous 2-year depreciation is 50,000. Per year is 25,000. The asset is being depreciated on a straight line basis. This means this year depreciation will also be 25,000, but we need to charge for 6 months after held for sale. There shouldn't be any depreciation. So the depreciation for this year will be 12,500. Is that? Number 5. At the reporting date, an asset is identified as an asset held for sale after meeting the criteria as per IFRS 5. Where should the asset appear on the statement of financial position? Where it should be presented?
Below current asset.
Separately below
Current.
current asset heading. Okay. Cat or K? CAT cat, KAT cat, Kit cat. Yeah, it's Kit cat. Has a year end of 31st December. On the 1st January 20X9, it classified one of its freehold property as held for sale. At that date, the property had a carrying amount of 667,000 and had been accounted for according to the revaluation model at start of the year. Its fair value was estimated at 825,000 and the cost to sell at 3,000. In accordance with IFRS 5 non-current asset held for sale and discontinued operation, what amount should be recognized in the statement of financial statements for the year to 31st December 20X9? So on 1st January, it classified one of its freehold property as held for sale. At that date, the property had a carrying amount of 667,000 and had been accounted for according to the revaluation model. Its fair value was estimated at 825,000. What are the options? Statement of profit or loss, gain of 155,000. Will there be any gain? No. Statement of profit or loss, impairment loss of 3,000. Revaluation gain nil. If we are recording asset on revaluation model, so we need to revalue. What's the difference between 667 and 825? 825. 158. So this 158 should be recorded as revaluation surplus. Its fair value was estimated at 825. Fair value means market value. In revaluation, we need to compare market value with carrying amount. And the cost to sell at 3,000. Cost to sell at 3,000. This 3,000 should be recorded as impairment loss separately.
Can you explain again why we don't include 3,000?
Because in revaluation, we don't need to consider cost of sale. In revaluation, we need to compare carrying value with market value. In revaluation, we don't need to consider cost to sell. We need to consider what? We need to compare carrying value with market value. If market value is higher than carrying value, there is a revaluation gain that should be charged to revaluation surplus. If carrying value is lower than market, is higher than market value, there is revaluation loss that should be charged to profit and loss account. Its carrying value is 667, market value is 825. So there is a revaluation gain of how much? 154 that should be charged to revaluation surplus. You know, but and the cost to sell 3,000 mean we will record the asset in balance sheet with how much amount? 154 less 3,151. And this 3,000 will be charged as impairment loss.
What if instead of cost to sell, if it is remodeled by something to for selling the
Selling price is not given. If market price is given, this means it's going to be sell at this amount. But we have read that if our asset having revaluation model, so at the time of asset held for sale, we need to revalue it first. So option C saying statement of profit or loss gain nil, statement of profit or loss impairment loss nil, and revaluation gain of 155,000. No. What's the option D? What's the difference between these two amounts? Is that 154, 158? 158. So then statement of profit and loss, there shouldn't be any gain loss. Statement of profit and loss, impairment loss of these 3,000 cost to sell and revaluation gain of 158. Because in revaluation, we need to compare carrying value with market value, not fair value less cost to sell. So first we have revalued it. Now we are classifying it held for sale. How? Carrying value. What is the carrying value now? 825. Less lower of carrying value or fair value less cost to sell. So the loss or gain will be recorded in profit and loss account. Number 7, for each issue identified the correct accounting treatment in Madira's financial statement. A loss-making division which Madira have agreed to close next year. A loss-making division which Madira have agreed to close next year. When they will discontinue? In next year, whether they have decided in current year, they have made public announcement in current year or not, no information is there. So there will be no treatment for this. Because you need to show the loss or profit separately.
You said agreed. Yes, that means they would have.
Agree to close next year. Next year might be, it doesn't say in next 12 months.
Doesn't next year mean next 12 months?
If it is decided in current year, they will discontinue within next 12 months, then we are having complete information. So in next year financial statements, we will disclose it at discontinued operation, not current year. The factory of Madeira, which is being marketed, means sold at a reasonable price at year end. What is that? I said held for sale. Madeira's specialized plant, which will be advertised for sale once it has been dismantled. Is not ready to sell immediately. So this chapter completed. Hope to see you in next class with something new.
One day.